Right now, in a glass office tower in Tokyo, decisions are being made that could quietly determine the cost of your next car loan, your mortgage, and the future of your retirement account. The financial news is obsessed with the Federal Reserve, but they might be missing the bigger story. For the better part of 2 decades, the global economy has been running on a hidden engine of cheap Japanese money. Now, that engine is sputtering. This isn't a forecast. It's happening as we speak. And we are going to break down how this debt shock from Japan is starting to rewrite the rules of money for everyone. Section 1. The calm before the storm. For most of the last 20 years, Japan was the land of zero. Zero inflation, zero growth, and most importantly, near zero interest rates. After its economic bubble burst in the early 1990s, the country entered a long, grinding period of stagnation. To fight off deflation, the Bank of Japan, or BOJ, did something radical. It made money cheaper than anywhere else. It pinned interest rates to the floor. And in 2016, it rolled out a policy called Yield Curve Control, or YCC. This was a complex way of saying it would buy as many government bonds as needed to keep the 10-year yield locked around 0%. This created a paradise for borrowers, but a desert for anyone trying to save. If you were a big Japanese institution, like a pension fund or an insurer, you couldn't earn a decent return at home. So where did you look? Abroad. For years, a river of Japanese capital flowed into global markets, chasing higher returns. Japan became the single largest foreign holder of U.S. government debt, with its holdings primarily from the official sector climbing over $1 trillion. This had a profound, though often invisible, effect on all of us. That constant, reliable demand for U.S. Treasuries helped keep American interest rates artificially low. It made mortgages cheaper, it fueled corporate borrowing, and it propped up stock prices. It also gave rise to one of the most popular trades in finance, the yen carry trade. The logic was simple. Hedge funds and other speculators would borrow yen for practically nothing, sell it, and use the cash to buy higher-yielding assets around the world, U.S. stocks, European bonds, you name it. This trade became a massive, silent source of global liquidity, pushing asset prices higher. For years, this was the status quo. An anchor of cheap Japanese money helped stabilize and subsidize the entire global financial system. But that anchor is now being pulled up. Section 2. The trigger. The world changed after 2022. A wave of inflation swept the globe, and for the first time in a generation, it truly took hold in Japan. Prices started rising, and crucially, so did wages. The Bank of Japan, after decades of trying to create inflation, suddenly faced the risk of getting more than it bargained for. With its currency hitting multi-decade lows and inflation looking sticky, the pressure to act became overwhelming. The era of zero was over. The central bank began the slow, delicate process of normalization. It officially ended negative interest rates in March 2024. Then, in June 2026, the BOJ hiked its policy rate to 1%, the highest it's been since 1995. It also began cautiously backing away from its rigid yield curve control. Suddenly, the foundation of the global financial system started to shift. The yield on a 10-year Japanese government bond, JGB, which had been stuck near zero for years, began to surge. As of mid-2026, it has climbed toward 2.75%. For a market used to no returns at all, that's a seismic event, and it's all happening in a country with government debt to GDP ratio estimates hovering between 200% and 250%. This isn't a policy choice made in a vacuum, it's a forced reaction. The trigger has been pulled, and two different but connected financial shockwaves are now heading for our shores. Section 3. The first shockwave, the Great Repatriation. So, why should a rising Japanese bond yield matter to you? The first reason is the risk of what some are calling the Great Repatriation. Think back to those big Japanese institutions. For years, they bought U.S. treasuries because there was no alternative for a safe return. But now, an alternative is emerging. Why take on currency risk buying a U.S. bond when you can finally get a decent and rising yield right at home? The logical answer is you might not. We are potentially at the beginning of a major shift in global capital flows. The automatic default bid for U.S. debt from Japanese buyers is no longer a given. The risk is that they could begin to slow their purchases or even start selling foreign holdings to bring that money home. This is where it could directly impact you. The U.S. Treasury market is the bedrock of global finance. Its interest rates set the benchmark for almost every other loan in the world. If the largest foreign holder of that debt even just steps back, the consequences could be huge. With less demand, bond prices fall, and their yield must go up to attract new buyers. Some economists have estimated that this shift alone could add a persistent 0.2% to 0.5% to U.S. 10-year Treasury yields over the medium term. While that's a projection, not a certainty, it would translate directly into higher costs for everyone. It could mean more expensive mortgages, higher interest on car loans, and increased borrowing costs for businesses. The silent subsidy we've enjoyed for years is being withdrawn, and US interest rates may now face permanent upward pressure no matter what the Fed does. That is the first potential shockwave. Section 4. The second shockwave. The carry trade implosion. The second shockwave is a different beast, faster, and potentially more chaotic. It's the risk of the yen carry trade unwinding. Remember that free money strategy of borrowing yen for nothing to speculate on global assets. That trade only really works as long as two things are true. Japanese interest rates stay near zero and the yen stays weak. Both of those conditions are now reversing. As the Bank of Japan raises rates, the cost of borrowing yen goes up. And as the prospect of capital returning to Japan grows, it creates potential buying pressure on the currency. Now, imagine you're a hedge fund that borrows billions of yen. A strengthening yen is a nightmare scenario. The value of your debt suddenly balloons in dollar terms, forcing you to act. This is what traders call a sprint for the exits. To pay back those now expensive yen loans, speculators would have to sell the assets they bought. This is where the danger lies. The scenario involves forced selling of US stocks, European bonds, real estate, whatever they can liquidate to get cash, buy back yen, and close their positions. This wouldn't be a gradual rebalancing. It would be a rapid, widespread deleveraging that could cascade across markets. While estimates of the carry trade size vary wildly, with some analyses suggesting it's smaller than often feared, a sudden, panicked unwind could still remove a significant source of liquidity from the system. The rules of the game are changing in real time, and what happens in the Japanese bond market doesn't stay in Japan anymore. These are complex, connected shifts that often get lost in the day-to-day headlines. If you want to stay ahead of these seismic changes and understand the hidden forces driving the markets, make sure you subscribe and hit the notification bell. We cut through the noise to give you the analysis you need to protect and grow your capital in this new era. Section 5. The aftermath and the new reality. So what does this new world look like? The era of the Japan anchor is ending. We are likely entering a new regime defined by structurally higher global interest rates and more volatility. The cheap funding that helped inflate asset prices for a generation is evaporating, and we're starting to discover the true price of money. For your portfolio, this has several direct implications. First, long-duration assets, things whose value is based on profits far in the future, like high-growth tech stocks, are under threat. Their sky-high valuations were often justified by low interest rates. As global rates rise, those valuations face a serious gravity problem. Second, expect more turbulence in currency markets. The tug-of-war between a normalizing Japan and other major economies will create powerful currents in foreign exchange, impacting everything from international trade to corporate profits. There are two potential paths forward from here: an orderly adjustment or a disorderly unwind. An orderly adjustment would see a gradual return of Japanese capital and a slow deleveraging of the carry trade. This path would still lead to higher borrowing costs and lower asset valuation, but it will happen over time. A disorderly unwind, however, could be triggered by a sudden policy shock or a spike in global risk aversion. That would look like the second shockwave, the carry trade implosion happening all at once, potentially leading to a sharp global market event. For nearly 2 decades, the global financial system had a secret partner, a hidden source of cheap capital and artificial stability flowing quietly out of Tokyo. Investors and policymakers in the West grew comfortable, focusing on their own central banks, while often overlooking the massive systemic plumbing controlled by the Bank of Japan. That secret is now out. The normalization of Japan's monetary policy isn't just a foreign story. It is a fundamental rewriting of the global financial architecture. The potential withdrawal of Japanese capital and the unwinding of the yen carry trade represent two phases of the same powerful event, a global repricing of risk. This isn't a problem for tomorrow. It's one of the most significant macro-financial forces at play today. The mainstream headlines may be late to the story, but now you understand the hidden wiring. And in the turbulent era ahead, that understanding will be your most valuable asset.